Hello, everybody. Welcome to a special edition of Sofi Weekly. We've got the earnings that are live. We've got Chris, who was nice enough to join us and help us break down everything that's going on. Riley, Tanner, and Tevis. Big day in the world of SoFi, Q1 2023. We're not going to waste any time, and we're going right into it. Here we go. This is what we got for earnings. We beat EPS by 29%. And the stock is up about 8% pre-market. Let's start with member growth. I guess that's the first. Actually, well, why don't we do overall quick thoughts, and then I'll get into the numbers. Let's do something like that. Chris, what are your overall thoughts, or raw overall thoughts on earnings?
I'd say it's a mixed quarter. So financial services was really strong. Well, I think probably even stronger than I expected. Lending came in about where I expected. The tech platform is concerning. Revenue's down, and the margin is basically flat. And then member growth actually is a lot lower than I expected. And in terms of percentage growth is down a lot. So mixed, overall good. I mean, the thesis is still on track for most things, but the tech platform, they need to shore it up. And I hope that analysts drill down on it in the call, because they don't often talk so much about that. They talk more about the bank. But that's the portion that honestly they need to follow up on. So those are my raw thoughts.
Tevis, your raw thoughts?
Yeah, I would say mixed is a good way of putting it. I wasn't necessarily, the happiest with this quarter. I think partially because our expectation of SoFi that's now deeply embedded in the back of our mind is that they'll triple beat. And so that's become our baseline assumption that they will. I mean, members was weak. Tech platform down year over year. The EPS I was expecting to come in, stronger. So, they beat, but definitely by not as much as I was thinking in the back of my mind, or I was forecasting. But so I'm excited to just hop on the call and see what management has to say about the quarter.
Okay.
I thought this was a pretty, I mean, the only thing that was sucky to see really was the tech platform. But we've been talking about this. Like I've said for countless times that management can say how great this product is, but until we start seeing numbers, it doesn't mean anything. Every single CEO is going to say that their platform's the best. So just because it came out of Anthony Noto's mouth doesn't mean anything new. But that being said, I saw your guys' SoFi Weekly last week. I think expectations were set way too high. I think it was a great quarter. We beat EPS by almost 30%. That's a really great quarter. And of course, there's going to be markets that are hard, but that's why we're so diversified. Is that when one thing like the tech platform isn't doing so well, that other things like all the interest that we're making on our personal loans can make up for that.
Okay. And finally, Riley, your thoughts on the overall quarter?
Well, raw thoughts, I'm kind of, I just woke up and I'm looking at the numbers right now, and I don't know what to make of it. I really want to see what they have to say about all the Galileo accounts. Last quarter was 131, and now we're at 126.
Well, they talked about somebody was leaving, right? One of their bigger clients. So that was sort of expected.
And they don't name drop their clients either, so we don't know which one.
Yeah.
So I guess we didn't actually say what they did relative to analyst expectations, so we probably should. So analyst expectations were like 441 or 442 million on revenue, and they came in with 460 million. And then on EPS, analyst estimates were minus 7 cents. And where did they come in? I actually didn't see that number.
Minus 5.
Minus 5. Right. And the total number was like minus 34 million or something.
Yeah.
In GAAP net loss.
Yeah, 34.5.
Yeah.
And then so sequentially, I guess what we're talking about regarding the tech platform. So the last 3 quarters in a row, it was the revenue was 84 million, 84.7 billion, 85.6 million, and this quarter was 77.8 million. Right. So it was an overall drop in the tech platform.
Yeah, I mean, so let's go straight to Galileo first. So 131 accounts last quarter, 30% year-over-year growth. Q1, it's down quarter-over-quarter, year-over-year, it's up 15%. And the margins on this are flat. So I guess if we take a step back, what do we think this is saying about Galileo? Either they're not putting enough time and effort into caring about this to be able to keep the quarter-over-quarter growth because they're caring about all their other divisions, or maybe the demand just isn't that strong from the market for Galileo.
Yeah. So, well, okay. So one thing I will say is that this could have been just one or two, big clients just leaving the platform. So there is some concentration in the Galileo side of the business, and I think Galileo side is also, being our B2B stream linked to the macro. If on a macro perspective, not a lot of these companies are expanding, investing in their growth, investing in their infrastructure, so on and so forth, then that's obviously going to affect Galileo. Despite the main B2C business being up and growing, because on, like, to Tanner's point, they are diversified, the Galileo B2B side is almost like a bellwether into what the other banks are feeling in terms of where they're putting their investment dollars.
Yeah,
Okay.
and if I want to add to that too, I mean, there's no new fintechs coming up right now. There's like that was the amazing thing during 2020 and 2021 is that there was just so many new people to go after whenever it came to fintechs. That's all dried up. VC money is dried up. So that's why we've made that shift to larger banks, and they said that the sales process for them is going to take a much longer time. Whether or not we're going to close any of those big names, I mean, from what I know, or rumors have been going around that we already have relationships with a lot of these big players. It's just not a deep portion of their overall business. But we're going to have to wait and see if that does turn around. But in terms of the actual very specific stuff, that's what we're here to listen to the call, right? Like that's going to be amazing insight, and definitely because it is dropping, that analysts will be on it for sure.
I think it's important to note why Galileo accounts are important. Probably a lot of first-time viewers here. Sofi did have a good quarter, but the whole thesis behind Sofi is that we're going to be the AWS of fintech. It's not we haven't said this. The CEO and the CFO have said this in past quarters. Like, this is their strategy. Galileo is that AWS of fintech, and this number does matter. So it might sound that we're harping on Sofi, even though they did a good job. Like, this is important. Yeah, I guess in the short term we really don't know. Because they just started rolling out all this new features starting January.
Yeah,
especially in advertising.
I can see the comments, and one of the comments is hearing you guys out. It feels like Sofi missed their earnings. Don't get us wrong. This is a great earnings. They triple beat across the board. The stock is up over 6% already in pre-market, and I suspect that it's going to continue to go up in the earnings call. Like, these are good numbers. It's just because we cover Sofi on a daily basis, we're focusing on the nitty gritty stuff, trying to flash what the warning signs are ahead of time. And I mean, we're starting off this podcast talking about the most negative thing in the report, which is the Galileo counts. But a lot of the numbers here are good. We're going to get through it as we go through the call.
And part of the reason that we're also highlighting it, I think, is because long term, like Riley said, this is the biggest part of this is the part of the business that could scale the most, right?
And have the best margins.
And have the best margins long term. I guess lending is always probably going to have really good margins as well. But that's kind of why we're harping on it. And then also, it's just human nature, right, to focus on the things that are negative and that don't meet your expectations, even though the rest of it is doing quite well.
Chris, can you give us the 30-second breakdown? I don't think we've ever heard you kind of explain it. Why do we think Galileo could be the AWS of fintech? You did write a whole article about this.
So the basic idea is that the way that AWS originally was built is Amazon had to build out a bunch of infrastructure for their e-commerce business. So they had to build logistics, they had servers, they had extra server space, they had extra warehouse space. And Jeff Bezos said, if we're going to build all this stuff for us, why don't we just rent out what we do to other people? So there's all these other companies that also have need of hardware and servers and somebody to run their website. And so initially he started, and even like warehouse space, right? So he was like, they were renting out literal space in their warehouses to other people. And so they monetized that and it became the AWS, right? Which is currently their growth driver. So it grew way, way bigger than originally thought. And so the idea for SoFi is the same, which is SoFi wants to be vertically integrated in their bank, which means that they want to own the core, they want to own the payment processing, they want to own the debit card issuing, they want to own the fraud and risk protection. They want to own the entire stack. And so since they're investing into putting all this R&D into building this infrastructure, then they're going to turn around and sell that to other fintechs. So if another fintech has an idea for something that they want to do, then Galileo has a turnkey solution that says, hey, you can set up deposit accounts and we'll give you debit cards and you can be up and running in 30 minutes and you can cater to whatever clientele or find your niche or whatever. And so that's the idea is they're investing in R&D now for things that they're building for SoFi themselves to be vertically integrated and to be the low-cost provider inside the fintech space. And then they're taking that infrastructure and that investment and turning it around and selling it to other fintechs so that they use it.
And to quickly add to that, there is a big question, like why does SoFi need to build this infrastructure? Why can't anybody else build this infrastructure? There is misaligned incentives throughout the entire market when it comes to this type of technology. Old banks, rich banks are still run on like very old software and they don't have any incentive to change because there's no competition and regulatory bodies don't care because they're meeting all the regulatory needs. So there is no incentive for big old banks to modernize their backend infrastructure. What is it? CEO Anthony Noto, he hasn't said this tagline recently, but a few quarters ago, you would hear him frequently say the words next generation banking core, like back-end technology, which is far more advanced than what a lot of banks are running on today. So the idea is that sooner or later, all these banks are going to have to switch over to a new modern banking core to be able to keep up with, like neobanks, online banks, margins, and a lot of these banks that don't have this back-end infrastructure are going to be looking for a provider, and SoFi is going to be there, casting a huge net for when all these banks have to make this inevitable transformation on the back end. So that's the strategy.
And I mean, look, if we sort of agree at the highest level that the Galileo segment is really a byproduct of the macro environment. I mean, it's B2B, right? The other businesses have to be in a position of growth, in a position of investing in their infrastructure, in a position of wanting that sort of one-stop shop from a technology aspect. Then we have to consider what macro environment we're in right now, right? Like the macro environment is I can't focus. I'm freaking Tanner's cat. It's so cute. The macro environment is brutal right now. And considering all of this, I think that, we need to take these results as well with a grain of salt, because we have banks that are collapsing left and right. I mean, FRC just last week. And meanwhile, here you have
JP Morgan just seized FRC.
JP Morgan, right? Just seized FRC this morning. And here we have SoFi still triple beating, still raising guidance. And the only thing that I want to hear on the call really with regards to Galileo is on the Q4 call last quarter, management said, hey, we expect these margins to come back by the end of the year. I want to see how they're going to still do that now that we have the, weaker than expected Galileo numbers in Q1, right? So if they have, let's say, that high target to reach by the end of the year, this Q1 didn't really help them. They're still in that rough patch, let's say. So I want to see management address that immediately, and I definitely think that analysts are going to ask around that.
What do you guys think about member growth? This is the first quarter it's declined. quarter over
I got
quarter.
a great answer for that.
But year over year, it's up. Go ahead, Tanner.
Okay. Maybe I should share my screen really quick, just because
Yeah,
there was a
go ahead.
couple Noto comments that he had spoken about. So talking about the 433,000 new members, I'll try to make it as big as possible while keeping it all on the screen. He said sales and marketing expense as a percentage of revenue declined approximately 100 basis points sequentially, or approximately 475 basis points year over year. So this is what we've been talking about for a couple quarters now. The focus on profitability is extremely real. They're not worried about gaining more than 400,000 members. That's always been their target. You know what I mean? So there's no reason to expect so much more than that, because they're just going to cut costs after they pass their target. And then really quickly here, I want to read this whole part because it's really interesting. Noto said, total deposits grew $2.7 billion, up 37% to a total of $10 billion. 90% of SoFi Money deposits were from direct deposit members, and the new direct deposit members had a FICO score of 749. Okay, this isn't the personal loan target. This is the SoFi Money target, which they have no reason to incentivize only affluent clients. They'll take anyone in, but it still happens to be affluent clients because they're the people that want the 4.2% in their
Tanner, what is
check.
SoFi Money? What is SoFi Money for the people that don't know?
Just their basic checking and savings account. Sorry, this cat is really trying to climb all over my set here. Okay, just really quick, and then also SoFi Money, like the checking and savings account. The chance that someone signs up after just 30 days of starting an account for direct deposit is more than half, more than 50%. And then whenever they're launching $2 million FDIC insurance, that now covers 97% of deposits. 97.
So maybe Chris, I'm curious, what is the discrepancy with the bank numbers that we saw in terms of total deposits? Like, why is there 350 million less, something like that?
I don't know. That's a good question. I mean, I don't want to speculate just because I really don't have any information on it.
Anybody, Tanner, maybe you have any thoughts? Basically, SoFi Bank reported $3 billion.
3 billion.
It could be deposits versus interest paying deposits or something like this. I don't know what the difference is. And honestly, my weekend was a write-off, so I didn't really read it too much.
Got it. All right. Hopefully they address it on the call then.
Yeah.
How did we feel about products growing? I mean, this was, the fact that they were able to do these as originations. This was good, right? 46% year over year. Definitely not bad.
So I think on products, the one thing that stood out to me, if you look at the total products now, SoFi Money is their biggest, that has the most products of any of their financial services. So it used to be Invest, and then I think last quarter it might have been Relay, or maybe it was just that Relay was growing faster than everything else. But now their money accounts, so their checking and savings accounts, are higher than anything else, which is good, right? Because those are people who, well, at least 50% of them, right, of their new SoFi Money people are direct deposit members, and those are the type of people who are going to stick around and who are going to be really high in terms of lifetime value of the members.
Okay. We got Galileo, lending and financial services. So this was the one that we were, I guess, most happy about. Lending is up 24% year over year, and financial services up 51% year over year.
Yeah, do we want to cover really? Well, first of all, that's awesome. 24% growth, holding up our highest growth rates on lending is amazing, especially while home and student loans are doing terribly. Someone just put up in a comment, maybe we can address it before the call at some point, is the new product that they announced along with earnings.
Yeah. Before we jump into SoFi Travel, just last one point on the lending. It's the only one that doesn't have a declining growth rate. Financial services products has been declining. Galileo declining growth
which
rate.
Is to be expected.
Not as in going down, as in going up by less every quarter, which is to Tanner's point, to be expected considering the company is getting bigger and bigger. it's harder to keep those same high percentages.
Right. Okay. SoFi Travel. Tevis, what is this thing?
It's a partnership that with Expedia that offers SoFi members new benefits. SoFi is launching a new travel booking portal, and they're going to give you member discounts. They're going to give you a 3% cashback rewards on your bookings that you make with SoFi credit card. We talked about this in the past. I mean, look, this was one of the ways that they can add to that product offering, that flywheel. If you are a SoFi member in their ecosystem, they can give you all kinds of different benefits through these different partnerships, right? Today, SoFi Travel is a partnership by Expedia. They can partner with any other company and offer you different benefits that you want to see as a member just because you are in that ecosystem. And so they incentivize you from the credit card aspect. They incentivize you with the APY from the savings aspect. And so once you're in that ecosystem, there's a lot of different benefits that you can have. And SoFi Travel, this was something that we were talking about in the past couple of months, and it seems that they just finally launched it. I mean, fantastic to see, right? Just another benefit for the members.
Yeah, I'm sure the way it works is that partnering with Expedia, they're able to order through Expedia. Expedia will give us a lead generation fee, and so we can offer a higher credit card benefit. And so it's an incentive to use SoFi's not only for the interchange fees, the loan on the credit card, but also probably a lead generation fee with Expedia. It's potentially a start of a rolling ball with a bunch of great companies. They could do this with, who knows, Airbnb and a bunch of other places, and then offer a same sort of similar product that incentivizes people that whenever you think about money, you think about SoFi. If you're thinking about spending, if you're thinking about saving, you think about this one company. You don't need to go anywhere else. And Expedia, being the large name that it is the perfect company to start this off with. It's honestly way better than what I was expecting. I was expecting them to build their own thing, and obviously people were still going to use Expedia. So this is a good way to, not only incentivize new users of Expedia, but also, concurrent ones, and just doing it through their banking app.
Yeah, somebody asked in the chat, they said, do we think anyone will join SoFi for this perk? I don't think so. But I think it makes the products themselves much stickier. And if you're already a SoFi member and you don't have the credit card, this is probably a perk that would make it so that you'd consider that credit card, right? So it's more about, I think it's more about cross-selling than top of the funnel, but that's it.
And it's not it's not a like a what do you call it? Like a loss product. I forget what they I'm trying to say.
Loss leader.
Loss leader. Yeah, that's not what it's even designed to do. We will be making money on this product. you know what I mean? So even if a couple people use it, it's definitely to our benefit.
Yeah, I don't see any other banking app that actually has like this in-app offering. And I don't know, depending on how much data sharing they're going to have with Expedia, it's going to be interesting. Because more data, more ways to monetize it.
Well, it's interesting, right? Because in that PR, they were saying that SoFi members are going to be earning their cash back with SoFi rewards points. So just still keeping members in that ecosystem. So you can imagine a world where, let's say you're a full SoFi member on their checking and savings on their credit card side, you're earning APY, one of the highest out there, if not the highest out there, on their savings account, 4.2% APY. You're going to get your 3% cash back on your credit card. You're going to get all of these points through SoFi rewards that are going to have some type of conversion rate with the Expedia interface. And then you can use these points, to travel today, but later on, there might be another partnership, with other vendors that might have more preferential conversion rates for your points, right? And so the entire time, SoFi is gathering your data. They're gathering your spending patterns, your habits to better curate future products to you, and they're keeping you into that ecosystem with that flywheel, incentivizing you to cross-sell onto other products. So wildly bullish, and again, it goes towards their one-stop shop mantra of keeping all of their users.
So I guess real quick, because the call is going to start really soon. We should probably call out, or I want to highlight also the positives, right? We've been somewhat negative because like we expect a lot, right? Like we have high expectations for SoFi because they've executed really well. So I mean, they did beat revenue by analysts' expectations by 7%, which is awesome, right? They beat earnings by 20%, 30%, which is awesome. The bank, if tech platform takes a little while to get off the ground, it's okay as long as the bank can bankroll it, right? Like AWS was also a loss leader for Amazon for a little while because they were using their e-commerce business to fund it, right? And the R&D that's going into the tech platform does have big returns, both for SoFi as a bank and then also for the tech platform. And so like there are a lot of positives and there's lots of things to like, and I guess the long-term thesis, I think, for me, so the tech platform has always been a bit of a question mark as far as when it will scale, when it will become really big. But the long-term thesis on the bank itself and on SoFi, I think in general, is confirmed, right? So, we're not going to get like a 30, 40, 50% pop on this. But long-term, like if you look at SoFi versus every other fintech in the market and every other bank right now in the current environment, they are absolutely killing it relative to everyone else, right? FRC just went under, Lending Club guided down, right? And SoFi guided up, and they actually did almost exactly what Tevis and I said they do the other night, which is that like they're going to beat and then they're going to raise just a little bit and they're going to set a bar that they can get over, and that's exactly what they did. So their guidance for next quarter is just slightly above analyst expectations, and for the full year they raised it again just slightly. And
that's testament. Just one little addition there. That's just testament to SoFi's leadership team to have the ability to do that. They know how this game is played, what analysts look for, what the market looks for, what a lot of these algorithms out there that have the algorithmic trading look for, and so they can play to that. Even if it is, let's say, a $1 million beat and a $1 million raise, that it still checks those boxes. Sorry, go ahead,
yeah.
Chris.
No, you're totally fine.
Talk about stock-based compensation.
I think is confirmed. Stock-based compensation came down $7 million quarter over quarter. So again, revenue went up 7%. Stock-based compensation came down something like 10%, right? And
you thought it would only go down 5% on Friday, Chris.
I said at least 5 million, right? So I wanted to be conservative in my estimate. I'll have to run the numbers, right? Like once the 10Q comes out, because they're not in these numbers, but I'll have to update my spreadsheet and see what I think. I don't think it'll come down as much in Q2 as it did in Q1 because a lot of the performance stock units were rolling off. But again, it just shows like, if you look at long-term trajectory of the business, of the stock-based compensation, of the expenses, of the marketing, like long-term, everything's really confirmed, except for, I would say the one problem, right, is still the tech platform. And it'll be really interesting. I'm very interested to see what they say on the call about that, because long-term, I still think it's going to be growing. It may not end up being like the rails that the entire financial industry runs on, right? But there's still like, it's going, I think this is a lull due to the macro environment and it'll come back. But the difference is that SoFi is still growing everything else during this lull. Whereas if you look at every other bank, pretty much except for like JP Morgan, and that's because they're too big to fail, so they get free deposits, which is ridiculous, but that's another discussion, right? Not ridiculous, it's great for them. And it is like, anyway, we won't get into that. But the point is that everybody else is really struggling and SoFi for the most part is killing it. And that's the biggest takeaway long term. This is why I buy shares and like deep in the money calls if I buy calls, right? Is because this is a long-term investment for me. It's not a trade.
All right, call is about to start. We're going to be live streaming the call. Thank you to the 800 people that are here across all three channels amidst Tanner's and mine.
I'm probably going to hop off. I don't know if I'll be on later on, but thanks for having me, guys.
Thanks for bringing it down,
Chris.
Thank you, Chris.
Yep.
Chris,
Okay, we'll
really
talk to you
good
later.
take. Thank you so much. Have a good one.
Okay, so probably in like 30 seconds, so we'll start. We didn't find out anything about Wyndham yet, right? We need the 10Q.
Not yet.
Yeah, we would need that.
They're probably going to get asked about it, so we'll wait for that.
Why did we borrow $780 million?
The unanswered question that hasn't been answered since Friday. Yeah, I mean, overall sentiment from everyone in the chat seems to be great quarter, not bad quarter, just not phenomenal quarter.
So stock is up.
Yeah, we're just not breaking ground on every single aspect.
Yeah,
And you know what? That's healthy.
And that's fine too. That's normal. Stock is up 6.5% right before the call is going to start. So we'll see how that tracks throughout the call.
Tevis, your SoFi community is much more dedicated than my channel's SoFi community.
Well, you cover like a gazillion stocks.
Shit.
Also,
Tevis' channel is trending on YouTube homepage.
Are you serious?
If that's true, we're about to get like 1 trillion viewers if that's happening. Wait, so Chris, so everyone, I mean, the only way to test that is if you sign out of YouTube and then we go to trending, because sometimes your trending is specific to you, Chris.
Yeah, maybe.
So we know Chris binge watches your channel now, so he's fucking so
we know Darth Chris hopped on my channel. I saw it. I was just like, welcome, but also, oh fuck, you're gonna make all my viewers particularly
the fucking bull in disguise.
First comment was JPM better than SoFi.
All right, we're here. Oh, well, she said
good stuff. Amit.
Did she? I just heard a lady's voice, and then go back to the fucking music.
All right, can I show something really quick or no? Will we be able to hear it while I'm sharing my screen?
No. Oh, I would just have to share your thing real quick. Go ahead. I'll share yours real quick.
No, I was just going to show the. We could do it after. We could do it after if we're staying on the call after the call, which I assume.
Yeah, we'll be on for like 30 minutes after the call. Do we know how much cash they have on hand? Maybe we can figure out how much. Well, yeah, 10Q. That's going to tell us a lot of the questions like that. Going to buy another 1,000 shares. Okay.
Yeah, the problem with that is that you don't know how their cash is, changed during that time. It can't just it's not the only purchase they've ever made,
I predict stock will go down if their loss is higher in this quarter than what it was in the previous one.
Well, it isn't, so it'll go up. I'll predict that one for you.
Price estimates after data. So I guess they're asking price estimates after the call. I don't know, man. I think we maybe retain this 3% we're up, but it'll get sold off by the end of the day.
Also depends on how the wider market is doing today. If it's a massive red day, then that's going to mute the earnings. If it's a massive green day, then obviously it's going to give us a boost. But it seems like we're trending up. I mean, we broke 7% in pre-market. Obviously, that's very low volume compared to the actual trading hours, but if that means anything.
So let me see.
Guys, these financial bots,
Today's SoFi first quarter 2023 earnings conference call. All lines will be muted during the presentation portion of the call with an opportunity for questions and answers at the end. At this time, I would now like to turn the conference over to our host, Maura Sear from SoFi Investor Relations. Maura, please proceed.
Thank you and good morning. Welcome to SoFi's first quarter 2023 earnings conference call. Joining me today to talk about our results and recent events are Anthony Noto, CEO, and Chris Lapointe, CFO. You can find the presentation accompanying our earnings release on the Investor Relations section of our website. Our remarks today will include forward-looking statements that are based on our current expectations and forecasts and involve risks and uncertainties. These statements include, but are not limited to, our competitive advantages and strategy, macroeconomic conditions and outlook, future products and services, and future business and financial performance. Our actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are described in today's press release and our most recent Form 10-K as filed with the Securities and Exchange Commission, as well as our subsequent filings made with the SEC, including our upcoming Form 10-Q. Any forward-looking statements that we make on this call are based on assumptions as of today, and we undertake no obligation to update these statements as a result of new information or future events. And now I'd like to turn the call over to Anthony.
Thank you, Maura, and good morning, everyone. The first quarter at SoFi was an incredible beginning to what is already turning out to be yet another eventful year in the macro environment.
Sounds pumped.
Amid all the volatility, we delivered another quarter of record revenue and adjusted EBITDA with strong overall operating results, reinforcing the strength of our strategy and our ability to execute with excellence. A few key achievements from the first quarter include our 8th consecutive quarter of record adjusted net revenue, of $460 million, up 43% year over year, with record revenue in lending and financial services, as well as continued strength in tech platform. Our third consecutive quarter of record adjusted EBITDA at nearly $76 million, representing a 48% incremental margin and a 16% margin overall. An incremental GAAP net income margin of 54%, resulting in a loss of just $34 million. Deposits increased by $2.7 billion sequentially, marking another record quarter, and now exceed $10 billion in total deposits. Importantly, more than 90% of our consumer deposits are from sticky direct deposit members, and 97% of our deposits are insured. Our cash and cash equivalents on the balance sheet increased by $1.1 billion to $2.5 billion since year-end, reinforcing our strong liquidity position. Once again, we are achieving several financial inflection points. Adjusted EBITDA of $76 million is now greater than stock-based compensation at $64 million, which actually declined. And this is another critical step towards GAAP net income profitability. We achieved positive variable profit in the financial services segment and remain on track for positive contribution profit by year-end. Additionally, lending net interest income revenue, or NIM revenue, of $201 million exceeded lending non-interest income of $136 million for the second consecutive quarter, and importantly, our NIM revenue is meaningfully greater than our lending segment directly attributable expenses of $115 million. These trends increase the visibility and reinforce our goal of achieving positive GAAP net income in Q4 2023. Along those lines, we had another quarter of positive GAAP net income for SoFi Bank at $73 million, reflecting a 20% margin and a 23% return on average tangible equity, on our way to expected 30% returns within the bank over the long term. Lastly, the quality of our bank operating and liquidity metrics remain robust and have improved since year-end. We saw new record levels of unaided brand awareness in the quarter and continued strong cross-buy trends, which helped drive strong year-over-year growth in members and products with decreasing marketing spend intensity. The 433,000 new members in Q1 23 brings total members to nearly 5.7 million, up 46% year over year. We also added 660,000 new products in Q1, ending with nearly 8.6 million total products, also up 46% year over year. Of these new adds, financial services products totaled 7.1 million at quarter end and grew by 51% year over year, while lending products of 1.4 million were up 24% year over year. Sales and marketing expenditures as a percent of revenue declined nearly 100 basis points from last quarter and nearly 475 basis points from a year ago. The strength of our results once again underscores how our full suite of differentiated products and services provides the foundation for a uniquely diversified business that is able to endure through market cycles as well as exogenous factors. We talk often about our ability to act nimbly in a rapidly changing environment. There were several examples once again this last quarter, but I'd like to take a moment to highlight one that really exemplifies nimble execution to truly help our members at the most critical time. As the recent bank crisis developed, our team was able to bring our deposits FDIC insurance capabilities from offering $250,000 to $2 million within a week, providing comfort and safety to our members and enabling 97% of our deposits to now be insured versus 92% before the increase. Now I'd like to spend time touching on segment level results, as well as the structural advantage of our product strategy and having a bank charter. In lending, we generated a record $325 million of adjusted net revenue, up 33% versus the prior year period. Our personal loan performance more than offset the continued headwinds in demand for student loan refinancing and the less robust performance of home loans. Student loan refi continues to be impacted as federal borrowers still await clarity on the end of the moratorium on federal student loan payments. Home loans faces macro headwinds from rising rates while we continue the process of integrating Wyndham Capital Mortgage, which we acquired at the beginning of Q2 2023. The personal loans business maintained its strength in Q1, hitting record originations of nearly $3 billion, up 46% from $2 billion in Q1 2022. This product continues to deliver even as we maintain our stringent credit standards and pass on rate increases to our borrowers. While these origination levels themselves are impressive, the strength of our balance sheet and diversification of our funding sources provide new options to fund origination growth while driving efficiencies with cost savings. These advantages are a direct result of SoFi Bank. Having more balance sheet flexibility allows us to capture more net interest income and optimize returns, which provides more stable earnings in any macro environment. But it's especially important in times of excess volatility. As of the end of Q1 2023, 44% of our loans were funded by deposits, and our $2.7 billion of new deposits raised in the quarter helped fund our $3.6 billion of total originations in the most cost-effective way. Our lending capacity remains robust, with over $20 billion in total capacity to fund loans and meet our liquidity needs, with $10 billion of deposits, which have grown by $2 billion a quarter, $3 billion of equity capital, and $8.6 billion of warehouse capacity. Lastly, the bank contributes to strong growth in SoFi Money members, high-quality deposits, and great levels of engagement. This has led to higher average account balances, even as average spend has increased. More than 50% of newly funded SoFi Money accounts are setting up direct deposit by day 30, and this has had a significant impact on spending. Q1 annualized spend was 2x 2022 spend, and Q1 spend per average funded account was up 15% quarter-over-quarter. SoFi Money members have increased over 48% year-over-year to 2.4 million accounts. Given the quality of these members with a median FICO score of 749 for our direct deposit portfolio, we see ample opportunity for cross-buy. This is a great segue into financial services more broadly, where net revenue more than tripled year-over-year to $81 million and grew 25% from $65 million in Q4 22. Contribution loss of $24 million improved $19 million versus the previous quarter, and we achieved variable profitability for the first time in the segment, even as we maintained elevated marketing expenses in the first quarter. We've continued to achieve strong member and product growth by iterating on products to ensure they are differentiated on 4 key factors: fast, selection, content, convenience, and continuing to invest to make them work better when used together. So far in Q2, we continue to iterate on these products. Last week, we raised our savings rate again to 4.2%, and just this morning we announced SoFi Travel in partnership with Expedia, which will include member discounts and 3% cashback rewards on bookings made with the SoFi credit card. SoFi Travel is a digital destination that represents our first non-financial product effort to help our members spend better and the next phase in SoFi's mission to help our members achieve financial independence. We finished Q1 with 7.1 million financial services products, up 51% year-over-year, and 5x total lending products of 1.4 million. The increased scale in financial services helps drive cross-buy and marketing efficiencies. Financial services sales and marketing spend as a percentage of net revenue was 51% versus 60% in Q1 of last year. We continue to scale our top-of-the-funnel products given the attractive monetization opportunities by capitalizing on our improved brand awareness and network effects. We saw this increased efficiency even with the fact that these products have a 12 to 18-month payback period. For technology platform, full segment revenue of nearly $78 million saw a growth of 28% year-over-year with a 19% margin at the segment level, or 28% if you exclude Technisys. Galileo's overall diversified growth strategy includes growth in new verticals, new products, and new geographies with a focus on larger customers that have large installed bases. In Q1, Galileo signed 5 new clients and made big strides in this strategy, with 80% of newly signed clients having existing customers or portfolios, along with a growing pipeline of joint opportunities selling Galileo and Technisys offerings to an expanded customer base. Technisys recently signed 1 new client in Mexico and has entered into a proof of concept stage with a large U.S. legacy financial institution. With that, let me turn it over to Chris for a review of the financials for the quarter.
Thanks, Anthony. We started the year with a great quarter, which saw strong growth trends across the entire business. We achieved record revenue and adjusted EBITDA, despite operating in a rapidly evolving macro backdrop. I'm going to walk you through some key financial highlights for the quarter, and then share some color on our financial outlook. Unless otherwise stated, I'll be referring to adjusted results for the first quarter of 2023 versus first quarter of 2022. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and the subsequent 10-Q filing, which will be made available next week. For the quarter, top-line growth remained strong as we delivered record adjusted net revenue of $460 million, up 43% year-over-year and 4% sequentially from the fourth quarter's record of $443 million, and above our Q1 guidance of $430 to $440 million. Adjusted EBITDA was $76 million at a 16% margin, also above the high end of our most recent guidance of $40 to $45 million, and ahead of the prior quarter record. This represented 14 points of year-over-year margin improvement, demonstrating the strong operating leverage of the business as it scales. Year-over-year margin improvement has been driven by significant operating leverage across our sales and marketing, G&A, and ops functional expense lines. Overall, this resulted in a 48% incremental adjusted EBITDA margin year-over-year. Our GAAP net losses were $34 million this quarter, which is a $76 million improvement year-over-year and a $6 million improvement sequentially. Our incremental GAAP net income margin was 54% for the quarter. In addition to our adjusted EBITDA margin expansion, we saw meaningful leverage against stock-based compensation as a percentage of net revenue at 14% in Q1 2023, down from 16% in the fourth quarter and 24% in the prior year quarter. This represents further progress toward our expectation of GAAP net income profitability in Q4 2023. Now on to the segment level performance, where we saw strong year-over-year growth across all three segments. In lending, first quarter adjusted net revenue grew 33% year-over-year to $325 million. Results were driven by 113% year-over-year growth in our net interest income, while non-interest income was down 17%. Growth in net interest income was driven by a 99% year-over-year increase in average interest earning assets and a 318 basis point year-over-year increase in average yields, resulting in an average net interest margin of 5.5% for the quarter. This represents roughly 110 basis points of year-over-year NIM expansion. Q1 originations grew 7% year-over-year to $3.6 billion and were driven by record volumes in our personal loans business, which grew 46% year-over-year to nearly $3 billion. However, student loan originations were down 47% year-over-year and home loans by 71% year-over-year, as the extension of the federal student loan moratorium and macro factors continue to provide headwinds to these businesses. We achieved this top-line growth while maintaining our stringent credit standards and disciplined focus on quality. Our personal loan borrowers' weighted average income is $164,000, with a weighted average FICO score of 747. Our student loan borrowers' weighted average income is $173,000, with a weighted average FICO of 769. This continued focus on quality has led to strong credit performance. Our on-balance sheet delinquency rates and charge-off rates remain healthy and are still below pre-COVID levels. Our on-balance sheet 90-day personal loan delinquency rate was 38 basis points in Q1 23, while our annualized personal loan charge-off rate was 2.97%. Considering the weighted average life of the personal loans on our balance sheet, our portfolio life of loan losses are forecasted to be 4.5%, which is below our risk tolerance. Our on-balance sheet 90-day student loan delinquency rate was 12 basis points in Q1 23, while our annualized student loan charge-off rate was 0.34%. As we've expressed in the past, it is reasonable to expect credit metrics to revert over time to more normalized pre-pandemic levels, but continue to expect very healthy performance relative to broader industry levels. The lending business delivered $210 million of contribution profit at a 65% margin, up from $133 million a year ago and a 54% margin. This improvement was driven by a mix shift to higher margin personal loans revenue, as well as sales and marketing and ops efficiencies and fixed cost leverage across the entire segment. Shifting to tech platform, where we delivered net revenue of $78 million in the quarter, up 28% year over year, while Galileo revenue was up 3% year over year. Overall, annual revenue growth was driven primarily by Galileo account growth to 126 million in total. We also signed 5 new clients in Galileo and 1 in Technisys, and we finished the task of moving every client to the cloud, with 100% of transactions now migrated. Sequentially, revenue and contribution profit declined in the segment due to seasonality in transaction volumes, along with timing implications from shifting focus to larger potential partners with larger existing businesses, B2B customers, and a more durable customer base, which has longer sales cycles. The segment delivered a contribution profit of $15 million, representing a 19% margin, and 28% if you were to exclude Technisys. Moving on to financial services, where net revenue of $81 million increased 244% year over year, with new all-time high revenue for SoFi Money and continued strong contributions from SoFi Credit Card, SoFi Invest, and Lending as a Service. Overall, monetization continues to improve, with annualized revenue per product increasing for the 4th consecutive quarter to $45, 2 times the $20 in the prior year, and up 15% sequentially from $40. We reached 7.1 million financial services products in the quarter, which is up 51% year over year, and we continue to see strong product adds with 584,000 new products in the segment. We hit 2.4 million products in SoFi Money, 2.2 million in SoFi Invest, and 2.2 million in Relay. Contribution losses were $24 million for the quarter, which improved by over 50% year over year and 44% sequentially as we start to see operating leverage in the segment. Importantly, we achieved positive variable profit in the financial services segment for the first time, which reinforces our expectation of positive contribution profits by the end of 2023. Switching to our balance sheet, where we remain very well capitalized with ample cash and excess liquidity. Last year's opening of SoFi Bank further reinforces our strong balance sheet and provides us with more flexibility and access to a lower cost of capital relative to alternative sources of funding. In Q1, assets grew by $3.4 billion as a result of a $1.1 billion increase in cash and cash equivalents, highlighting our strong liquidity position and access to cash, as well as adding loans to the balance sheet given strong growth we continue to see in personal loan originations. On the liability side of the balance sheet, we saw tremendous growth in deposits as they grew to over $10 billion, up $2.7 billion sequentially, versus $2.3 billion in each of the prior 2 quarters. Because of this, we exited the quarter with just $3.5 billion drawn on our $8.6 billion of warehouse facilities. In addition, last week we extended our corporate revolver for another 5 years and upsized it to $645 million. This further highlights our strong liquidity position, particularly in this market. Our available for sale securities portfolio remains quite modest at $175 million market value, with $6 million in cumulative unrealized losses versus $195 million at year-end 2022. This portfolio consists primarily of short-duration government-backed securities. Let me finish up with guidance. Throughout the last 12 months, we have demonstrated the benefit of having a diversified set of revenue streams, multiple cost-efficient sources of capital, and a keen focus on underwriting high-quality credit. We expect those benefits to persist going forward, even in light of existing macro backdrop. For Q2, we expect to deliver adjusted net revenue of $470 to $480 million and adjusted EBITDA of $50 to $60 million. For the full year of 2023, we are raising guidance and now expect to deliver adjusted net revenue of $1.955 to $2.02 billion, up from our prior guidance of $1.925 to $2 billion. And we now expect full year 2023 adjusted EBITDA to be $268 to $288 million, up from our prior guidance of $260 to $280 million. This represents a 30% incremental EBITDA margin for the full year. Overall, We couldn't be more proud of our Q1 results and continued progress. Having delivered over $460 million of adjusted net revenue and $76 million of adjusted EBITDA, we continued to make great progress against our long-term growth objectives in the quarter and remain very well capitalized to continue pursuing our ultimate goal of making SoFi a top financial institution. With that, let's begin the Q&A.
The exciting part.
We will now open the lines for Q&A. Analysts will each be allowed to ask one question. If you would like to ask a second question, please re-enter the queue. Our first question comes from the line of Mihir Bhatia with Bank of America. Your line is now open.
Good morning. Good morning. Thank you for taking my question. Maybe to start, Chris, if you could just provide the loan sales and gain on sale margins this quarter, with and without hedging, if possible, please. And just talk also about the larger strategy. Is there any change as you've grown deposits to hold loans for longer, or is it still very much a buy and distribute model? Thank you.
Yep, no problem. So I'll hit on each of the products, starting with our home loans business. So in home loans, we ended up selling $78 million of principal at a 104.7% execution level, inclusive of hedges. It was about 100 basis points less than that. In our personal loans business, we did not do any whole loan sales in period. Our last one was in Q4 at 104.4% execution, but we did execute a $440 million consumer loan ABS transaction with spreads that outperformed our expectations, and we were able to price at 90 basis points over SOFR. The deal was 8 times oversubscribed with over 28 orders, which allowed us to tighten spreads meaningfully by 80 basis points relative to the deal that we did back in Q4 that had comparable collateral. The market obviously continues to search for shorter duration securities backed by higher credit collateral. And then in student loan refinancing, we did not do any whole loan sales in period. Our last one was in Q3 at a 104.4% execution. What I would say in terms of your second question, Mihir, as we've discussed in the past, we are extremely well capitalized at this point, having raised $3.6 billion in 2021. We have access to $8.6 billion in warehouse lines, $3.5 billion of which is drawn currently. And our bank deposit base of $10 billion is growing really quickly, with the vast majority of our deposits, more than 90% of them coming from direct deposit members. In addition to that, we've been able to successfully access the ABS markets each of the last 2 quarters, which have brought attractive fixed financing options for all of our loans. Given this flexibility, we're always going to maximize returns on the loans that we originate, as well as the overall firm ROE. And that's going to take different forms given the environment that we're operating in at any given point in time. This quarter, similar to last quarter, we had the flexibility to hold loans for a longer period of time, particularly given the growth that we saw in deposits of $2.7 billion, which resulted in really strong net interest income. But that could certainly change in future quarters, but we have a lot of options and flexibility today.
Thank you. Our next question comes from the line of Jeff Adelson with Morgan Stanley. Your line is now open.
Yes, hi. Thanks for taking my question. I was just wondering if we could dig in a little bit more on the loan growth expectation from here. You know, you've been doubling the loans every quarter, year on year, and I understand you have a lot of capital at this point, but is there a point at which you feel like you need to start selling your loans again? And then I guess on the actual loan sale side, what gives you confidence that the loans you're marking on your balance sheet today, if you were to start going back to the market again, what gives you confidence that you can kind of hold on to those marks you have on the balance sheet? Thanks.
Great point.
Thanks, Jeff. First, what I'd say is that our overall strategy as it relates to loans and when we sell them versus hold them is really driven by liquidity and our ability to optimize return on equity. It's the same strategy we've had since 2018. Our ability to execute it has only become more and more strong and robust so that we have maximum optionality. I would love to remind everyone that if you think about our liquidity stack and our funding stack, we have $3 billion of equity or own equity capital that we can fund with $8 billion of warehouse facility, and then as we reported today, $10 billion of deposits. That source of funding allows us to be very nimble in what we decide to hold versus what we decide to sell, and also allows us to be very nimble as it relates to loan purchases of SoFi loans and other opportunities that we have as optionality on deals over time. So in essence, there's no one answer to your question. It's about maximizing our ROE and making sure we have the right liquidity and making sure we have the right capital ratios as a bank. I'll let Chris talk about the way we think about the value of the loans in the marketplace.
Yeah, absolutely. And in terms of why we get confident in the sense that we would be able to sell the loans at where they're currently marked, every single quarter we work with a third-party valuation firm that marks to market each and every one of our loans on an individual basis to account for changes in every single factor that impacts the loan. So that's things like the weighted average coupon, default rates, prepayment speeds, benchmark rates, spreads, as well as where secondary bonds and residuals are trading. So you see that mark to market take place every single quarter, and that flows through the revenue line of our P&L.
Our next question comes from the line of Kevin Barker with Piper Sandler. Your line is now open.
Great, thanks for taking my questions. I wanted to follow up on the acquisition you announced a couple months ago on Wyndham Capital. You mentioned that it's going to be accretive within the next 6 months. And I believe they did about $2 billion of originations last year, according to some press reports. Could you just give us an idea of like how big you expect the mortgage platform to be? And then what does the accretive within 6 months guidance imply? Did you have to do a significant amount of further integration within the SoFi platform, or is a lot of that already existing within Wyndham? Thank you.
And how much did you pay?
Thank you. First, let me approach the question about home loans from a strategic standpoint. As many of you know, we want to be a one-stop digital provider for all of your financial needs during all the major decisions in your financial life and all the days in between. In order to do that, we have to be there when you make large decisions, like how you pay for college, like how you may pay for grad school, medical school, or buying a home. We've taken an approach over the last 5 years where we prefer to vertically integrate with our technology. It gives us lower costs. We can innovate at a much faster rate. We can make better real-time decisions, more personalization. The mortgage industry, as you know, is very cyclical, and it can really be challenging if you take actions at the height of the market from an acquisition standpoint or other investment standpoints. We've worked hard over the last 3 years to find a technology and a platform that we could buy at a great price, a small dollar amount that could be integrated pretty quickly and allow us to accomplish the objectives that I mentioned for vertical integration. We couldn't have been happier to find Wyndham. We think it's a phenomenal team. It's a long-term durable company, just the way that Galileo and Technisys was around for decades, and it was founder-led, and Jeff will continue to stay with us at SoFi. The integration will be done throughout the year. It is not significant in size in terms of the bandwidth that we have to allocate for that integration, so we feel like we can make it accretive by the end of the year. In terms of the volume they were doing, as you can imagine, the environment's been very challenging for home sales and refinancing, and so the volume was quite low relative to historical levels. And you should really think about it as a technology integration and significantly increased capacity for us to step on the gas pedal to increase our market share gains. And we intend to do that on the back of the full integration. So expect it to have a much more meaningful impact in 2024 once we feel great about the ability to scale not just the technology, but our processes and our people to ensure our members have a great experience. Time to fund is critically important in purchase mortgages, and we want to have the best time to fund possible for our members with high satisfaction. I'll let Chris talk about the accretion.
Yeah, so overall, what we assumed in the back half of the year is that this was not going to have a material impact on the overall business, either from a top line or bottom line perspective, but from an accretion perspective, we expect it to deliver a positive contribution.
Thank you. Our next question comes from the line of John Hecht with Jefferies. Your line is now open.
Thanks very much. Good morning, guys, and congratulations on a great quarter. I wonder if you guys can just talk about, over the course of the year, we've got certain things happening, like the potential moratorium ending for student loans and, obviously the changes that are expected in the interest rate markets. Maybe just considering all that, can you give us your kind of expectations for the mix of originations over the course of the next few quarters?
Yeah, sure. John, I can take that one. So what I would say is we aren't providing specific guidance at the product level, but we are expecting to continue to see modest growth in our personal loans business. This past quarter, we reached 8.2% market share. That was up from 5.8% last quarter and 5.5% a year ago. So there is significant headroom to continue to grow that business. But as we've said in the past, we are going to continue to be prudent and thoughtful about how we approach that business and won't overextend ourselves. So expect to see continued modest growth in that business, similar to what you've seen over the course of the last several quarters. On student loan refinancing, our guide and outlook has not changed from our Q1 earnings call or our Q4 earnings call. What was contemplated in our full year guide is that the moratorium would end on June 30th. And then people would go back into repayment 60 days thereafter, which means that we would see elevated demand for student loan originations in Q4, albeit at a lower monetization level given where interest rates are. We do think that there is still a large TAM that we can go after given where we can price the loans today. So we do expect to see an uptick in demand, but probably not to the levels that we saw back in Q4 of 2019. Then in home loan originations, Anthony just touched on it. We do expect to see an acceleration in originations given the acquisition of Wyndham Capital. Right now, we have a very, very low market share, so there's a ton of headroom to continue.
Thank you. Our next question comes from the line of Eugene Simuni with MoffettNathanson. Your line is now open.
Hi. Thank you. Good morning, guys. Congratulations on great results. I wanted to go back to the trends in your deposits. Great to see very strong growth in Q1, but can you elaborate a little bit on the trend in March since the beginning of the bank crisis, and maybe if you can share anything on what are the trends in April? And just maybe like a broader question here, how has the behavior of your bank customers changed at all since the bank crisis, and how are you adjusting to that? I'd love to hear your thoughts on that. Thank you.
It's another quarter since opening the bank about a year ago in February of continued strong performance of our SoFi Money account, which is checking and savings, as you know. The strategy has really played out in spades throughout the year, offering high interest rate on checking and very high interest rate on savings, up to 4.2% now if you do direct deposit with us, getting all the other member benefits that we provide for you beyond that, free certified financial planner, discounts on loans, our broad-based rewards program, all of which you now bundle into SoFi Plus, has really helped us drive not just strong adoption of SoFi Money, but a lot of engagement as it relates to both deposits and spending. We couldn't be more happy with the trends we're seeing in both of those. We expect them to continue into the second quarter that we've seen so far in April and throughout the May and June time period. What I'd say about Q1 is that it's really hard to sort of separate out what may have happened because of all the uncertainty and maybe a flock to safety as people trust SoFi and came to our product and used it more frequently. I would say the trends in April are off to a start that would indicate we should be at a similar level of $2 billion plus in deposits at the end of the quarter. In terms of spending, we continue to see really strong growth in spending as our direct deposit members increase, given that they're using it as their primary account. And so that's also a contributing factor to our financial results that sort of gets overlooked because of just the strong performance on NIM that we continue to see and how much more scale that is. But the spending trend on debit and so forth has really mirrored the trend in deposits as well as NIM to reinforce our overall strategy, giving us an opportunity to have more touch points and helping people get their money rate based on their spending and what's happening in their accounts.
Thank you. Our next question comes from the line of Reggie Smith with JP Morgan. Your line is now open.
Okay, good morning and congrats on the quarter. I only have one question, so it's going to be kind of long, I guess. I was curious, what are your loss expectations, life of loss expectations for your most recent cohort of personal loans? How does that compare to maybe your 22 cohort? And then a follow-up to that is, how are the 22s tracking relative to your initial expectations?
Good singular question
I'll
there.
let Chris get into the particulars, but at a high level, since 2018, we've architected our personal loans in a way that will drive to at least a 40 to 50% variable profit margin. And that includes all the variable costs, including life of loan losses and funding costs. The reason why we target that level of profitability is so that our loans are durable through the cycle. If we're seeing trends that lead us to believe that we can't get to that level, we will make changes. Sometimes that's increasing our WAC. Sometimes that's being more efficient in our marketing costs. Sometimes that involves driving down lower cost of funding. As it relates to the macroeconomic conditions impacting life of loan losses, we will tighten credit. We've tightened credit in the past. We have a very sophisticated real-time ability to test pricing and credit and a number of early warning economic indicators that have caused us to be more conservative on what we underwrite and tighten credit throughout the year, and we'll continue to do that. But we've been below our target life of loan losses of 7 to 8%, which is part of that equation of 40 to 50% variable profit margin. I just don't want people to think it's just about that metric. It's about the overall unit economics of getting to 40 to 50% variable profit margin, and that assumes 7 to 8% life of loan losses, which we've been below, and our cohorts have really continued to trend relative to that metric in a positive way.
Yeah, and I would just add on, if you look at all of our cohorts on a month-to-month, quarter-to-quarter basis, they've all been relatively consistent with the framework that Anthony just laid out. At the overall portfolio level right now, our annualized charge-off rate on the personal loans business is 2.97%. If you take the weighted average life into consideration for that portfolorial, it gets you to an estimated life of loan losses of about 4.5%, which again is meaningfully below the 7 to 8% risk tolerance level that we have today.
Thank you. Our next question comes from the line of Moshe Orenbuch with Credit Suisse. Your line is now open.
Great, thanks. And most of my questions have been asked and answered. But I thought, and you talked about this a little bit in the prepared remarks, but I think it's actually quite interesting in terms of the ability to increase, whether it's cross-buy or reduce marketing spend because of the increase in the number of members across financial services, SoFi Money. Could you talk a little bit in a little more detail, like how you would expect to see that playing out, over the course of the next year or two, and kind of more specifically, is it a function of, less marketing for consumer loans? Is it Lantern products? Like, what are the biggest benefits to SoFi?
CS is like, how do you not go bankrupt?
Yeah, so we talk about a concept called the FSPL, Financial Services Productivity Loop. And the concept is very simply, we want to leverage the broadest reach, most appealing high engagement products like Relay, like SoFi Money, like SoFi Invest, and SoFi Credit Card to really build a significant amount of products in those categories. As we build that scale, we have information about our members that allows us to give them personalized offers that best meet their needs. So, for example, if we bring in a SoFi Money customer member, and that member does direct deposit with us, and we see the mortgage that they're paying, or we see the student loan that they're paying, we see them sitting on a ton of cash, we see them overrunning and having a significant amount of credit card debt, we can make a very specific recommendation to them on how to get their money right in that particular area. We play that strategy out every day. Sometimes it's driven by technology and data, and sometimes it's driven by the mechanical processes of our teams, as well as our certified financial planners. That cross-buy allows us to bring in that second product with no customer acquisition cost, and has a huge impact on unit economics. So let's take a personal loan, for example, and this is just illustrative. Let's just say over the course of time, our average variable profit on a personal loan, and so that would be the revenue of that personal loan, less the life of loan losses, the funding cost, the variable operating cost, and the customer acquisition cost, results in $800 of variable profit. That could have a customer acquisition cost of anywhere between $600 to $1,000. If someone comes in through Relay and they do credit score monitoring, or they connect accounts, or they're in checking or savings, and we see that they have a bunch of credit card debt and could benefit from consolidation, we would make a term loan offer to them, or personal loan offer. If that person adopts that personal loan, the variable profit goes from $800 up by the savings on customer acquisition costs. So anywhere to $1,400 to $1,800. That significant variable profit dollar amount above and beyond what we need can then be reinvested in better technology, lower prices, better service, higher interest rate on checking or savings, and it drives the flywheel. We're seeing that happen across the board. Having the bank license only makes it better for us because we can now actually have lower cost of deposits, which improves our unit economics, both on SoFi Money as well as our loan products. So we're seeing the compounding benefits of that over and over. In terms of the outlook going forward, we average roughly about 1.5 products per member. I would expect that ratio to stay very similar over the next 12 to 18 months because we're driving really strong member growth. And if you think about the denominator, if it's growing really strong, it's really hard to drive the overall quotient of the products divided by the members. That's not a bad thing. That's actually a good thing because the bigger we make our member base, the bigger we'll make our products adopted by that member base over time. Over the long run, we hope to have every product with our members. There's not a specific, perspective that I have on the exact number, other than they should do everything with us. Why? We're trying to build the best of breed products by category, and so that we can help them borrow better, save better, spend better, invest better. And ultimately, if we do that, the number of products they have with us will be very large.
Thank you. Our next question comes from the line of Dominic Gabriele with Oppenheimer. Your line is now open.
Great. Good morning and great results. So, we saw significantly better revenue and adjusted EBITDA in the quarter, and I'm beginning to even wonder how much we need the student loan business to return for you guys to have a really strong franchise prevail. But the incremental adjusted EBITDA margin was higher than expected in the quarter. And if you take this quarter and the next quarter's guidance, you get still your roughly 30% expectation for incremental EBITDA margins. And so could you just talk about any shifts that may have happened between this quarter, next quarter, or if there's any seasonality as far as kind of that 30% expectation that we should be thinking about? Thanks so much.
Thank you for the question. As it relates to student loans, I want to break into two categories. You have private student loans, i.e. the loans that people are taking out to actually go to school. So we're in the in-school student loan business. We're also in the student loan refinancing business. That business is one that takes our members who have either private student loans or federal student loans and refinances them at a lower rate or a longer term to lower their monthly payment, much like the home loan refinancing industry. As long as a college education in the United States is not free, there will be a student loan market. Simply said, as long as the college education in the United States is not free, there will be a need for student loans. Sometimes those student loans could be provided by the government, and sometimes they could be provided by private institutions. Because of that dynamic, we will always be in the student loan business. The question is, are we just in the private student loan business or the private student loan business and the refinancing student loan business? I believe we'll always be in both businesses, regardless of what's decided by the Supreme Court on forgiveness and regardless of what happens with the moratorium. Why? The cost of education is significantly greater than the ability of people to pay. Therefore, they have to borrow money to do that. As long as they're borrowing money, we can find a way for them to not just get access to that loan, but to do it at a lower cost as they continue improving their financial lives. So it's never a question in our mind whether we're going to be in the business. It's just a question of what are the actual products and how do we best meet the members' needs. Because I'll just reiterate again, we want to be there for every one of the major financial decisions in someone's life and all the days in between, which means we have to be in the student loan business if we're going to execute our strategy. In terms of the particulars as it relates to EBITDA margin, I'll let Chris answer that.
Yeah, so in terms of the outperformance that we saw in Q1, Dominic, we saw revenue outperformance across both our lending and our financial services businesses, primarily attributable to net interest income, as I alluded to in my prepared remarks. From an expense perspective, we did see really good CAC efficiencies, given the strong member and product growth, particularly in lending, where our customer acquisition costs on a per loan basis was down 20% sequentially. And then in addition to that, we were able to manage expenses effectively, again, throughout the quarter, creating leverage across our entire fixed cost area. Collectively, the revenue outperformance along with the efficiency gains drove the excess earnings that we decided to drop to the bottom line and take more of a conservative approach given the uncertainty in the market. Overall, as we've discussed in the past, we strive to spend about 70% of our incremental revenue, as we've said. Depending on a number of factors, we may choose to drop more to the bottom line period to period, and that's what happened certainly this quarter. And you'll see periods of over-earning followed by deployment of those resources back into the drivers of the business.
And the only other thing I'd add is there's a lot of operating leverage in the business, and you're seeing that come through in Q4 and again in Q1. We are trying to balance investing to drive growth with prudent responsibility of driving towards profitability to give investors clear transparency on where our long-term margins and ROE can be. We couldn't be more confident about the long-term margins of the company and return on equity, but we need to move judiciously through the process of balancing both. One of the things I would tell you is that we've been driving the growth that we have and the improvement of profitability with our financial services segment being unprofitable. So the lending segment has a positive contribution margin, the tech platform has a positive contribution margin, and then we have large losses in financial services. The reason why that's the case is because there's a 12 to 24 month payback on customer acquisition costs. So we absorb that cost up front and then we recoup it over time. We're finally to the point that we're actually a positive variable profit margin for the financial services segment. That means we're actually covering all that customer acquisition cost. And the next step for us now that we're positive on a variable profit basis is getting the total variable profit dollars to be greater than the fixed direct cost of financial services. And once we do that, all three segments will have positive contribution margin. So we're just getting started with the type of leverage we can drive over time. We will dampen your expectations on where the margins will be in the intermediate term because we also want to keep investing. But we will hit the milestones that we've laid out as it relates to GAAP profitability and financial services positive contribution margin, unless there's a huge dislocation that we can't anticipate today.
Thank you. Our next question comes from the line of Robert Wildhack with Autonomous. Your line is now open.
Good morning, guys. I wanted to ask one more about deposits. Anthony, it sounds like you're talking about at least another quarter of really solid growth. So zooming out beyond that, what's the current strategy and line of thought with respect to keeping the pedal down on deposit growth versus maybe giving up some of that growth rate, but possibly taking a lot of pressure off your deposit costs and deposit betas?
Oh, good question.
The great thing about our company and our vertical integration is that the cost that we're currently have on our checking and savings account are lower than the cost that we've ever had in the business historically from a spread standpoint. So it's actually cheaper for us to fund via deposits than the way we've historically funded via warehouse lines. And so that's a huge competitive advantage. The reason we can offer the interest rate that we offer is because we actually make more money than we would with warehouse lines and without being a bank. And so the cost is completely acceptable where it's at, and we continue to be aggressive with the interest rate. I think the bigger question is what happens when rates start to get cut and go down. I think we'll be able to hold rate much longer and higher than our competitors and really gain even more market share. Our goal is to have as many direct deposit customers as we can. That's a leading indicator of primary account, and that's our strategy. Direct deposit's one indicator of that. There are others that we're using now and that will give people benefits from if they take those other actions outside of direct deposit. But the rate that we're providing is very competitive, but it's very attractive to us from a financial return standpoint.
Thank you.
I love
Our next
love that
question comes
answer.
from the
We'll talk
line
about
of
that.
Aaron Siganovich with Citigroup. Your line is now open.
Thanks. Just a quick question on the technology segment. It looks like the revenue is down a little bit sequentially. If you remove the client you lost, it's kind of flattish. Do you expect any pull forwards or contract renewals there? And what do you expect in terms of revenue growth for that segment going forward?
Yeah, one of the things we wanted to point out is that the technology platform is in a transition from a lot of small accounts and earlier stage startups to fewer, larger, durable customers. We made the decision throughout 2022 to stop chasing a lot of smaller deals. And so what you see in the quarter is less new customers coming on and contributing to revenue that would have been signed in 22 in the earlier part of the year. And that transition is ongoing. We expect the revenue to continue to stay at about this level throughout the year, and we'll start to see more meaningful contribution from some of the larger, more durable customers that we've signed up, a couple of which are actually on the platform now and contributing, but that will become bigger and more significant by the end of the year. We really like the strategy. It's longer lead times, it's longer sales cycles, but the economic opportunity from each one of these partners goes well beyond just using the processing platform or APIs at Galileo to a number of other products. One of the things that may not be obvious to everyone is that we're starting to see really strong traction in some of the products that are on top of the platform. So for example, Connecta is a natural language AI chatbot that helps with customer service. Sofi actually just integrated itself in our business, but it's got a great uptick from adoption from our partners. We also rolled out something called PRP, which is Payment Risk Platform. We're leveraging all the data on the Galileo platform. We process about 6 billion transactions a year. That gives us great intelligence to be able to detect transactional fraud. We're now offering that product and capability to our partners, and we've seen really strong uptake there. And then we also launched on our platform for the first time fully integrated Sofi, Galileo, and Technisys, a Pay in 4 product. The reality is it's an installment-based product that's like buy now, pay later, but it's delivered in your app. You apply in your app, you get a virtual card instantly, you get a card number, and you can execute that at any retail location or any online capability. It acts just like a debit card or a credit card, but has different economics in the back end. The great thing about the product is that it's driven all by interchange. It's not driven by a retailer's discount. It's not driven by an interest rate or a fee. And so there's a lot that's in the pipeline for the technology platform. The demand is as strong as it's ever been. We're going to move through this transition of fewer smaller accounts to fewer smaller accounts than what we used to do to get to these larger, more durable customers. And we should start to see the benefit in the back half of the year in terms of an acceleration of revenue and then into 2024.
It's a good answer.
Thank you. Our last question goes to the line of Matthew O'Neill with FT Partners. Your line is now open.
Hi, gentlemen. Thanks for squeezing me in at the end here. Just want to clarify, make sure that the prior question around the technology segment and the commentary around fewer smaller accounts and more larger ones going forward, is that directly connected to the small dip we saw this quarter in the Galileo accounts, just some smaller ones coming off before some bigger ones are being folded in? And then just as a separate follow-up, just curious on the macro front with what's going on in the rate environment. Is there a unemployment rate that you guys think about, where things would start to become more concerning, or there'd be some nonlinear impact, on the credit quality side? And, are we anywhere kind of close to that? The assumption is not, but just kind of curious what you guys are thinking about on the potential horizon.
Yeah, on the technology platform side, I think you're asking a question about accounts and the growth of that being slower year-over-year and down sequentially. That just reflects a partner that moved off the platform and those accounts moving off. So it's both new account growth offset by that partner that moved off in 2022 off the platform. In terms of the unemployment rate, I'll hand over to Chris to talk about how we think about underwriting credit and the macroeconomic factors that we're looking at.
Yeah, so our overall outlook on the macro hasn't changed from our Q4 earnings call. What we had talked about during that is that the rate curve was going to be consistent with where the forward curve was at the time, and peaking around 5 to 5.25% and exiting the year at 4.5%. So that's still contemplated in our current outlook. We assumed that the unemployment rate would be 5%, so we're holding with that as well. And we finally assumed that there would be a 2.5% GDP contraction. And then finally, we did assume that credit spreads would remain elevated. We have seen that over the course of the last several quarters, and we expect that to persist, heading into Q2, Q3, and Q4. But that's all contemplated in our guide.
And let me finish here by saying that we've been in an all-out sprint over the last 5 years to build out our digital product suite to meet our members' needs for every major financial decision in their lives and all the days in between. Thanks to the incredible grit and hard work of our team at SoFi, we've been able to do that consistently. That said, we've seen tectonic plate shift for the industry in each of the last 5 years, and in some years, multiple times. But through that volatility and uncertainty, we continue to prevail and thrive, hitting 8 record quarters of revenue in a row and hitting strategic and financial inflection points all along the way. 2023 has proven to be as formidable in just 3 short months as any year, and it's just getting started. We're likely to see another multi-tectonic plate shifting year. That said, SoFi will be ready. We'll be ready because the benefits of our strategy to build a uniquely diversified business combined with a national banking license not only positions SoFi to be the winner takes most in the secular transition of financial services to digital, but also provide greater durability through a market cycle and the many other volatile events that may occur. I'm excited about where we are today and even more excited about where we can go from here. With that, thank you for your interest in SoFi, and we'll talk to you in 3 short months.
He gets me pumped up.
This
All right, let's
concludes.
drop off. Holy. What were your guys' initial thoughts? Unmute.
Sorry, I was the thing was playing in the background. I had to cancel it.
Yo, Mizuho didn't ask a question this time around. Where's our boy Dan?
I don't know.
We had all these random ones like autonomous ST partners. Like, who are these people?
No one
New
asked
analysts.
about-
That's a good sign.
No one asked about Galileo. Or at
What do
least
you mean? Like, we got
A
like
bunch
3
of people asked about you.
Mate.
Okay, maybe
off
I
your
wasn't paying
phone.
attention enough. To be fair, I was sending out a newsletter while I was writing this thing up. Okay, but what were your guys' raw thoughts? Tanner, let's start with you.
That gave me a lot of confidence. Some of the things where they were talking about Galileo signing up a large, I'm glad that they said U.S. legacy player, because they've been doing a ton of things in South America, and that's great. But I wanted to see a U.S. large institution. And they added a couple other things near the end of the call where they said that the needs for the larger institutions are much higher, but it also leads to a much higher revenue per account, right? Because the people that use Galileo from these legacy systems are just going to have a much higher average revenue per account. So not only do they think that this is going to expand margin, because right now they said it's 19% if you include Technisys, 28% without, but they actually want to get that up closer to 40% with both of them combined. So like currently, not great. Could absolutely get great though. And depending on the large customer, whether it's, I don't think it'll be a JPM. I don't think it'll be a Bank of America. It most likely it's a Wells Fargo, a Citigroup, one of these ones. I think it'll be bigger than people think. They've been talking with a lot of people. I've heard rumors just from a couple of inside people. If there's any others, I'd love to talk. I'll never, ever expose your name. That there are some massive names on the table, bigger than people think. But yeah, sorry, that was just on the Galileo platform. There's a bunch of stuff, but let's just naturally get into it.
Yeah, I think just to pick up on that Galileo point, verbalizing the fact that we're not chasing the small fish anymore and we're going after the big fish, that has repercussions. And I think that people should adjust expectations for the technology platform. Why? Because naturally, as you go chase larger clients, Noto said it himself, they're going to have longer lead times, longer sales cycles. You might go a long time in between adding new clients. But when you do add them, you're going to make more money. There's going to be way more accounts. And generally speaking, that client, since they are a larger financial institution, makes slower decisions. They're going to be on your platform for way longer than some of these small players who just hop around all the time. And so there is very much like an 80-20 rule or a 90-10 rule, however you want to see it, in effect, where sometimes the majority of your gains happen from a very small percentage of your accounts. And Noto is basically saying, hey, why don't we just double down as a company on those large names and stop spending all of our efforts chasing all of these small names who, yes, they might be, close a deal in 30 days as opposed to 90 days, but they're also more likely to leave the platform, and we also don't get as much revenue from them anyways.
Yeah, not only is it just customer count, it's average revenue per account. And then even that, like, we see the slow gain for Galileo consistently now that's breaking trend. But this also means that if we do land this large, legacy banking system that wants an update, they could want the full on cloud system from Technisys, everything. Like the money could be amazing. And then you could also see I don't want to be over exaggerative, but a 10 or 15 million person or account increase from that single client rather than trying to rely on so many small players. It's almost the same debate as the do you want to make a bunch of YouTube videos or one big YouTube video? Like, I think they're going for quality now. That's really what they want.
One of the things that stuck out to me was when they were talking about the student loan business, and Noto was just like, look, as long as America has colleges and we don't subsidize it, we will have a business for us. The unique thing was the question that the analyst asked, which is like, do you even care about student loans? Because it seems like the business is doing good on so many other fronts. And student loans just seems like to be a cherry on top, which to me is one of the most beautiful things that we've transformed into a company that doesn't need to worry that much about student loans. Having said that, when it comes back, which it looks like the Supreme Court's going to knock it down 6-3, looks like Biden is definitely not extending it because they got rid of that state of emergency type of thing that we had on the federal government. That's going to be coming back by the end of the year in Q3, Q4, and might push us to GAAP profitability.
In line with their expectations, right? 60 days after the end of June. They did also mention, just on that student loan point, the second half of it was around the macro, I believe. One of the interesting things that I jotted down here is Noto said they have a 12 to 24 month payback time on their CAC.
Yes.
So they will recoup it over time. So looking at that marketing spend, looking at that, how much they're putting in sales and marketing, we can expect 12 to 24 months before that is reflected in revenue.
Are you guys going to bring up Riley's dumb joke?
Is this on Tavis's channel or Tanner's channel? Is Tavis you?
Not mine.
It's mine.
How can we trust your SoFi predictions when y'all's vision isn't even? Oh, because we all have glasses. That's so funny. It's hilarious.
Yeah.
Thanks, Riley.
Thanks, Riley.
Now get back to work, Riley. I mean, now you got to make back that $5.
What was I about to say? Oh yeah. So they still expect rate cuts by the end of the year?
Yeah. Well, they just said it was in line, and their expectation in Q4 was 2 rate cuts.
Yeah.
All right. Weird. And we know the Fed is raising on Wednesday by 25. It's pretty much all understood.
Do we know that?
So, I mean, we don't, but it's going to happen, right?
I'd assume so.
So
the prank call convinced me. Really quick though, I just wanted to touch on that student loan comment. They don't care about student loans. They don't care about home loans. Noto said very clearly they just have to offer it because they want to be a part of every transaction, right? This is where that one comment that he made was so great, is that they are not focused on, because I'm so worried about them just purely focusing on profitability, because then they become a boring old bank, right? That's not what I wanted whenever I invested in this company. I wanted a fast growing tech company, right? And depending on how you look at this company, you can look at it both ways. But whenever he said that primary banking relationships is what they're going after, and they will reduce their spreads, kind of cut back on the actual profitability to increase the percentage of the American population that they actually have a primary banking relationship. And this also plays into the student loans and home loans and everything, that we offer everything. In the long grand scheme of things, that will benefit us the most, because right now, like Noto said, we have 1.5 products per member. Okay. They expect that to continue for the next 12 to 18 months as they continue to scale members. But then obviously, as we start to take a larger and larger market share, it'll be harder. But then that's whenever we'll be cross-selling to these things, or to other members. And then the average revenue per user just skyrockets.
They didn't disclose the Wyndham acquisition price. I mean,
he definitely wasn't going to say shit on that.
We expect that, but they did highlight that, how it would help them in terms of.
Well, they did also say a small dollar amount, which I think I will concede to say that that's probably in your favor and less mine. And they went bargain shopping rather than tech platform shopping. You know what I mean? If they did get it because it was a bargain, then, they just picked up a great player at a great price. And I'm happy either way.
Right. They did mention that, Wyndham over the next 6 months, their guidance is, number one, that they're going to integrate throughout the year. It's not going to be a big integration. So, I mean, they did also mention that they were fully done this on cloud migration. 100% of transactions are migrated over. So it's really good that the Wyndham integration is not going to be large. The bandwidth is going to be low on the team. It can be accretive by the end of the year, which was really interesting to me, like how fast they can start ramping this thing up. It allows them to increase their market share gains, and they expect it to have a meaningful impact in 2024, probably to coincide with the rate environment sort of lowering in 2024, which is the macro expectation. And Wyndham at that point will be fully integrated as well. And so once you have all of those pieces together, then you can expect a really quick acceleration in 2024. Anthony Noto also mentioned they want to have the best time to fund. So that's one of the main metrics that he's looking at with regards to the Wyndham acquisition. So all positive signs there.
It's crazy how fast this bank can grow their loan portfolio. That was one thing. Whenever they said we have capacity for $20 billion worth of loans now. And I was just thinking, I'm like, man, how long ago was it that was $7 billion?
Right.
Like, not very long. We haven't been doing this podcast for a very long time, and it's scaling at an unbelievable rate. And that's mainly due to deposits. We have $10 billion in deposits that we didn't have before.
Right.
To add to that, they did say that they're on pace to do $2 billion plus in deposits for this quarter. That's not great. I'd be happier if they said 3 or something along these lines, but 2 is great. Or two is just fine. But anything else that you guys saw?
The estimated life of loan losses are about half to their threshold. They're about 4% below the 7 to 8% threshold. JPM asked about that. And he said, Anthony Noto said, hey, if we see life of loan losses, we'll just tighten our credit. We've been below our targets, well below our targets, like halfway to the target or the threshold. And they're just saying, hey, we can just tighten our credit. We're not in a position, quelling any rumors around this macro uncertainty for the business in general. Some other things. I took a lot of notes here. I'm just looking from the Q&A.
One thing I was going to say is just the confidence Noto had. I mean, every quarter it seems like he doesn't care. He's like, we are pushing through. No one. I mean, maybe I missed this part. I don't think anyone asked about Apple and them getting. I feel like no one really cared enough to ask about it. It wasn't even a big deal. And when it came out, all the media coverage Sofi is dead. It's like, no, that's not.
I made a comment to my chat. I was taking notes on how to start off YouTube videos with Noto's enthusiasm. Yes. He's welcome everybody.
Even the prepared remarks didn't sound kind of prepared because he sounded enthusiastic, not like a robot,
Mm-hmm.
What's it called? Apple's a bigger deal than you guys are giving it credit for, but I'll let it slide.
No, but Tanner, do you think it's funny that none of the analysts gave a flying fuck about? They didn't ask a single question on Apple.
Yeah, but what are they going to say? Like, they're going to ask, why don't we wait for May 4th to see what analysts say on Apple's call rather than what they're going to say on SoFi's call? Like,
I mean, I feel like if you're an analyst who's covering SoFi and this is an existential threat to the business by one of the biggest companies
what's
in
the
the world,
question, Amit?
I would ask, hey, how do you feel about Apple taking your lunch and making it so easy for someone in 2 steps to do deposits and get 4.2 APY or 4.15, whatever, and you not being able to? It seems like they realize they're not competitors. Like, it's not even something that they would worry about.
No, I think for pricing and interest rates, they're not a competitor. We
For
can always
loans,
price
they're
higher.
not a competitor.
Well, I don't agree with that. They have okay, we agree
Apple's
to disagree.
not giving out loans. So
Why are we bringing this shit up again, dude?
Yes, they are. Buy now, pay later's a loan. Okay, let's talk about something else. There was a couple different things that I saw here. One thing
over in my chat, we were just counting how many of the analysts actually congratulated them and just how many of them were just salty, just jumping into their question. And like all the analysts that were like core competitor analysts were like, congratulations, guys. Great quarter. Great to see it. And then JPM was like, okay, my question is this.
Yeah.
What's it called? Yeah. So they also said that they increased net interest income, decreased non-interest income. That's very much exactly what Lending Club did. We completely expected that. But the difference between the two companies is like the gap is widening. You can't lump SoFi into really any sector or industry anymore, aside from just financial services in general. But if you look at them against Marqeta, we have a complete lending business, so we can't quite price it that way. A lending company, no, right? And then because we're growing so much on our SoFi Money and all of our invest products, and we can't just be that because of all the 2 other segments. And that's also why if we were just Marqeta, for example, and we saw that member growth actually declined, the stock is up right now. You know what I mean? So we can have one segment have a hard time this quarter and still be an amazing success for SoFi. So this is the, I guess, compounding effects of having 2 different businesses, one that's strong enough to fund the other 2, and one that brings in enough users right now, which actually did turn contribution profitable, is what I think they said for the financial services this quarter, which is quite crazy. Very, very exciting.
Yeah, and I mean, look, net interest income, that is the second quarter now, I think, that it's higher than the lending segment expenses as a whole. So obviously, like, good to have it as a self-sustaining thing, up 113% year over year. The other thing on the financial segment, and LaPointe said this in his opening remarks, were the FICO scores and the average incomes of the personal loans and student loan borrowers. I mean, 749, 769 on student loan borrowers. They're fantastic FICOs despite us being in a rough patch on a macro perspective. And then the delinquencies as well, right? 0.38% delinquencies on personal loans, 38 basis points, 12 basis points, 0.12% delinquencies on student loans. Like the financial security, the financial health, like one of the biggest bear cases going into a tougher macro environment is that we're going to have higher delinquencies. We're going to have, the charge-off rates be affected, and SoFi is going to be negatively impacted. And we're just not seeing that right now. We're seeing the FICO scores remain high. The average income's 164 for personal loan borrowers, 173,000 per year for student loan borrowers. Like, it all contributes, right, to this 48% adjusted EBITDA margin year over year, to a lot of their records that they're seeing in adjusted EBITDA, right? Adjusted EBITDA was higher than stock-based compensation this quarter.
Well, how do you think they were able to get SBC down as much as they did? They were just like more financially responsible, or was there any other reason you think they got it down?
Well, it burns off over time as well, right?
Yes, Tanner, I'm sharing this right now. Go ahead. Oh, there you go. Stock-based comp right there.
So that's the stock-based compensation. It's not plummeting, but it's doing amazing, right? It continues to cut at a great rate. And as a percentage of revenue, that continues to drop because we're hitting record revenue. So
Right.
it's amazing. It's the double bonus that we want, right? And if that continues, that's going to look great.
Okay, so because I missed this part, what was the actual explanation by them on why Galileo is kind of slowed down this quarter? And is it a trend we should expect going forward, at least for the rest of this year?
Well, we touched on it a little bit. It's just that there's not a lot of new fintechs that they're going after. They're not going after the small players. They're going after large clients now. And the drop off was due to a large client that, you know, as the SoFi community, we rumor as being Revolut, just because they had some notices come out that they had new partnerships with Stripe and these sorts of things.
But Technisys getting one big legacy bank, that was interesting to me. Who is that bank, guys? Who is that bank?
JP Morgan.
I don't know.
No, they spend too much on tech for them to go elsewhere. But I would probably say it's one of the ones that don't like. Even Citigroup, me suggesting Citigroup doesn't even sound right to me because they own their own banking solution software. So yeah, but that kind of goes against what I just said.
Vadim
because
Citi.
Yeah, I know, but they are a competitor to Galileo. So I don't necessarily agree. They own banking as a software solutions, or banking as a service. It'll probably be like a Wells Fargo or something. That's more my belief. But I can see where maybe he's thinking Citi because they do have a large Latin American presence as well. So that connection with Technisys is already established. They've been a proponent with Technisys for a very long time.
I could see BAC too, Bank of America. But yeah, Wells I think might be, or HSBC, sure. Yeah, that's going to be really interesting, right? Because you think about the cross-sell. Technisys is more likely to onboard large financial partners that Galileo is already talking to, right? And vice versa, right? Because who are the first players that are going to be knocked off? It's the players that overlap in the Venn diagram between Galileo and Technisys. Those are the first ones before they even go for net new market, especially like Technisys in the US, they would have never gotten a legacy bank if it weren't for that acquisition that SoFi made when buying them and that merger into Galileo. Like they weren't even in the US market. So for Technisys to just go and onboard a big legacy financial institution, that is that cross-sell at play.
Right. Yeah. A couple other things that are very exciting is that they said that they're, still keeping their credit standards high as what we spoke about before the call. But a large reason is that it's not even because they're even trying anymore. The people who are interested in 4.2% on their savings accounts are affluent individuals, right? And so because we don't have any limits for 250,000, these sorts of things. So we're already getting this cross-sell of the people who are coming to our bank for our high interest savings are cross-selling into our personal loans because they're the same users that need it. And with Relay, right, another product of ours, we're able to see what exactly they need. That way they can cross-sell to it. And they answered one of the analysts, I guess one of the analysts that didn't understand the business of, cross-selling, but yeah.
I think that was Autonomous, who is new, right? Like Autonomous and SC Partners. We don't. I mean, well, look, the flip side of having
CS.
Who?
Yeah, right.
I've never heard of these guys either.
But the new analysts, the flip side of that is like we can get new initiations in price targets as early as later today, right? So a lot of these analysts are going to be raising price targets, and then the new ones, obviously, when they initiate a stock for the first time, that's definitely bullish as well, right? So it's a good thing that they're on the call.
There is one deceptive thing that Noto kind of said there that I just want to clear up. He said that although they have high APYs for their savings accounts and everything, they still have the best spread for cost of funding for deposits that they've ever had in the business, which is true. Okay. But that's true for every single bank.
Why?
Like Well, because the cost of funding elsewhere for warehouse facilities would be the same across the board practically. Okay. And so if that's raising to 6 or 7%, or well, more along the lines of probably 5.9 to 7, somewhere in there. But anyway, if they're keeping it down at 0.1% for their savings accounts, that means that their spread is more like 500-600 basis point spreads. Okay. So the fact that we have 4% and 6% is our bar. Yeah, we have a 200 basis point spread. That's huge. But compared to the legacy players, it's peanuts. So yeah, we have the best spread ever, but there are people that are bringing their cost of funding down, and that's being even more beneficial to their bottom line, making them more profitable.
Yeah, and it's one of the
good
things.
Though I want the growth.
It's just one of the things that contributes to the APY as well, right? Like them having an advantage in terms of their funding rates, they can have more to offer on the APY perspective. Is that?
Yeah, and the truth is that like if we didn't offer the 4.2%, maybe wouldn't even have had the deposits, right? So you can't just say, oh, why aren't you slashing it? Why don't you make yourself more profitable? Well, it's part of the sales strategy. So either you're putting it into sales and marketing or you're putting it into APY. It's bringing in new customers, right? So it depends where you want to write the expense off.
It's too big is what something was said to Tanner the other day.
Dude, okay, so man, let me say this. So I have.
I'm putting up the comment. It's the comment from Stop.
Hold on, let me just say one thing. I have all 3 streams here, and Tanner's engaging with the audience. He's like highlighting things in the call. I'm highlighting things in the call, and then I go to your stream and I scroll up, and the one thing you say is quote increasing our WAP. That's literally the only thing you said the entire call in your deep analysis to your poor audience.
Bro, they said whack and it sounded like WAP. And I'm like, huh, Meg the Stallion. That's I wonder what they're. Bro, I was eating breakfast. I'm getting a root canal in 30 minutes. I also have to leave in 5 minutes. Like my mind was in other places. And also this earnings wasn't that fucking amazing. So it wasn't that exciting, to be honest. Just being honest.
Such a hater.
It was a good earnings, but no, because fucking Chris got me hyped on Friday. He was like, we're gonna be gap profitable in the morning. And I'm ready. I'm excited. Then I wake up and I'm like, what the fuck is this? This is nothing. But obviously
I love Chris, but he's got some Riley tendencies as well. Like he does get so excited. Every quarter he says there's gonna be 500,000 new customers. I was looking at Steve being like, that's the only reasonable guy. It's only went up over 500,000 one time. And yet every quarter you guys are expecting this unbelievable rate, even though management has come out and said 400,000 is the bar. Anything over that, we don't care about. And over and over, you guys push this rhetoric that it's going to be so overly exciting.
This is why we needed you on the call, because we needed you to calm everyone down. Because Chris had me so excited. When I woke up this morning and I saw it, I was just like,
it's a fair point that you bring up, Tanner, on the member count, because Anthony Noto even highlighted it. Like basically we get to 400,000. That's our target. We'll just cut spend after that. And so, I mean, these are quarters when it makes sense for them to be more conservative on the growth side, given where the macro is. And so they'll just cut spend once they reach 400,000. So for us to be putting up these high numbers, it might seem like there's a declining sequential growth rate, like quarter over quarter. It's like 12%, 11%, 9%, 8%, whatever, in terms of the growth, because they're always baselining it off that aggregate number, which is 400,000. So the company gets bigger, the total members cross 5 million, and all of a sudden, that's 8% and it's not 12%. But that's something that they can absolutely control. They can control how much spend they want to crank behind these member growths. And so I don't think we should be looking too much into those sequential percentages, because it's all in SoFi's hands to add more spend if they want.
100%. You know what? The day that we start to get gap profitable, the market can relax, or even if the market changes and requires a new thing from management to push growth, so then I'll start to call out 700, 800, 900,000 new members. That absolutely can happen. You know what I mean? It's just, it's not a priority at all. And they continue to cut sales and marketing expense, which is good. Like knowing that we still threw up those large numbers and saved on costs allows us to, hit 5 cent or negative 5 cents EPS, which is a large beat. Like Jacob Hall said, I wish you would shoot up that thing. Is admit this was a triple beat.
No, I agree. It's not a bad quarter. It's just Chris had me thinking it's going to $9.
In the opening remarks, Shannon, to your point, Noto said this was record levels of unaided brand awareness in the quarter.
All right, the market is open. Wake your ass up. There's
dude, your parents must hate you, dude.
Yeah, my mom, she's home now. She absolutely hates me. The market is open. Everything is red except SoFi, to be honest. SoFi at 653, 4.74%. There we go.
It's becoming a norm here on the SoFi Weekly. You know what? Don't look at guidance as strongly as the quarter that actually comes out. Expect large beats. We're seeing it over and over. I get more excited to do these with you guys because I know that Anthony Noto is going to pull, out a great quarter, and I'm always excited to, do these lives with you guys. These are so much fun. This is a great company we have here. Very, very exciting.
All right. Having said that, that's it for us on the stream. Thank you all for being here. We appreciate it. 3 streams, probably the most. I don't know if we hit 1,000 last time. I think we had like 500, 600. So we definitely got a lot more people with doing multi-streams. Please like and subscribe to everyone. Everyone's in the description. Twitter's in the description. A lot more analysis coming up over the next week or two. And
or maybe a month. Because
a month.
the
10Q.
10Q is going to take a while.
Yeah.
Yeah.
All right,
everybody. Wait. Real quick. Before everyone logs off, are we doing this for other companies as well? Do you guys want to do an actual earnings call, like, for example, Nubank?
Bro, do you think I'm getting up at 7 a.m. for fucking Nubank?
Yeah, bro, I don't give a shit about Nubank. I'm sorry. You can do it, though.
That's all you, baby.
I will.
Okay, people are going to join you, yeah. It's just hard to care about Nubank.
Hard to care about the largest neobank in the world. All right.
Yes, no one gives a fuck. But SoFi, All right. We'll see you guys.
See you guys.
See you.
Bye.